Good evening, all. Ira Epstein with your agriculture wrap-up for the evening of Wednesday, December 11th, 2019, and we're just after 5:30, so I'm late again. We have been swamped here. A lot of business going on, a lot of year-end trading with the FOMC decision today, which was pretty neutral. Now we get tonight a vote, and I understand the House, and I'm talking the House of Representatives and the Judiciary Committee. We're supposed to get that thrown to the full House of Representatives for a vote of impeachment next week, and we've already heard the senator saying that first order of business next year is going to get that trial going and make it a short one and get it done with. In other words, the House predetermined the president was guilty. The Senate seems to be predetermining he's not guilty. You figure it out. Politics at its best in America, right? And I'm not criticizing. I've had people write me. That's not what I'm saying, just reality. All right, in the stock market and in ags, you got to be concerned. The next big event for you isn't Brexit in the ag market. You don't have to worry about that. That doesn't typically impact it. It's what does President Trump do by the 15th, which is this Sunday, concerning the next round of Chinese tariffs. That's going to be an important event. If he puts tariffs on, certainly sounds bearish to me for ags. If he gives an extension, it's sort of neutral. If we had a phase one deal, it's a positive for ags. And that's for the ags. I'm not bringing that into the other markets. When we look at the soybean chart, we're up for the week about 4 cents, and where's the market finding resistance? You look at that 18-week moving average of closes, that is the zone, which is not a surprise, because so often that number becomes a key number that the market makes its next decision from. When we go to the daily charts, this rally has suddenly petered out, if you will. And when you put the swing line on it, you have the pattern of lower highs and lower lows. You've had a very nice rally from the 882 zone to 917. Now the market's backing off a little bit. But it's backing off as it made a run for the 100-day average, and all it did today is pull back to its neutral number of the 18-day average of closes. That is still to say that the market's in a downtrend, it's had a bounce, it's pulled back to support. If it were to now take out 917 3/4, the market would look like a seasonal low. Besides this area, another reason for you to believe that that's the case. However, with the 100-day average, I'm wondering where the Bollinger Band resistance is. And that's far away. It's another 15 cents up in the 932 number. That's going to drop. It's been dropping on average, if you look at it, about 3 cents a day. You can see what the numbers are doing there. So just giving you a rough idea. So this, it could be the resistance. You could have another gap in there that there'd be more from. Who's in control going home? Actually, no one. And the reason is, while the swing line has got the lower highs, lower lows, which is a downtrend, the filter on it, where you close relation to the 18-day average, has upside bias. Anytime you're over that number, I say it's got upside bias, under downside bias. What about momentum? You've come up and you're sort of flattening out right here. So it's like a waiting game. Are we going to get a deal with China? Are we going to get an extension, or are we going to put more tariffs on them? That's what the question is. And then the devil's in the detail. The president wants to know how much they're going to buy of our ag. They're not willing to commit to unknown amounts or amounts they don't need. And they want a rollback of tariffs, and I'm talking the Chinese. Hard game to figure out. In the meal market, pretty ugly action. Lower highs, lower lows, stayed under the 18-day average. Bias is down. Next stopping spot, if it wants to extend this break, could be the 295 area. Even momentum's turning down. So this market, and remember, when I think that you have a bull market in the soy complex, often it's led by the meal, not the oil. And the oil market is just holding up here against the upper Bollinger Band. Doesn't act like the typical bull market, and that's what I'm saying. In the corn market, wow. I didn't expect this market to go back to the lower Bollinger Band. It hasn't done that since mid-November, and yet here we are with the market. That's not a bullish sign. You've got lower highs, lower lows. Admittedly, the market's been trading in a sideways pattern, but if it breaks out and gets under this, what could happen is this could become an area of a top. And you'd say, nah, look, you're oversold. And I'm going to teach you this again. When you first break out of sideways patterns on Bollinger Bands, you're often, if you break out to the upside, overbought or on the downside oversold. Then this catches up with the price action. So sideways action is actually extremely important when looking at what you're doing with the slow stochastic. In the wheat market, this was ugly. Yesterday, you had a reversal to the upside. So we saw the USDA supply-demand report. It looked good for the wheat market. You have an outside day up. My rule is, and it's just a chart rule that I use for myself, you should not take out the low of an outside day up within 2 trading sessions. If you do, I look for the closest of the Bollinger Band or where the key moving average under it, in this case it's the 100-day way down here, as a potential target. What would throw this back to the side and negate that is going back over the high of that outside day up. So right now, I think the bears regained control of the market. In the sugar market, if you get my morning video, I was willing to bet a penny with anyone listening that the market today would settle back under the upper Bollinger Bands. I didn't get many takers. They could have written me, and I would have liked my penny. The market did that. But I also said, this kind of strength is not something that creates a top in the market. Pulling back under the Bollinger Band with an embedded reading, all it is the market getting back in line with itself. I still expect to see buying on the brakes until you get that red line back under the 80 level. Coffee, look at how this market is just running the Bollinger Band with the embedded reading. And that's what I teach in my charting course. I teach you how to recognize these things so that you're not fighting them. The first and most important thing to me, not necessarily you, is I use that filter. When you're over the 18-day average, I'm not looking at short positions. I'm looking, why are you not getting long the market? It's a filter to be long. That's all I'm saying. Not I'm telling you where to buy it, but that's the filter. Be under it. If the swing line is down and prices are under it, I'm looking for reasons why am I not short the market, or telling you to be short the market. That's how you start thinking if you take the charting course. In the cocoa, battleground's the 18-day average. Why? Because while the swing line has got higher lows and higher highs, you've stayed under that 18-day average, which means bias is down. The two fight each other and you've got nothing. And now I'm looking at momentum sort of just drifting to the downside. The market breaks again, support 25.26. Rallies, resistance the 18-day average of closes. Cotton market, overbought. That's the first thing my eye goes to, and not a narrow trading range like corn was. This is much broader. Support back at the 18-day average. The pattern, higher lows, higher highs, but the overbought is a problem. Cattle market. The seasonals in the cattle, doesn't mean seasonals are anything more than what the market's done historic-wise, typically move higher from now into the first quarter of the year. Will it do it? Don't know. But like I talk about many markets, this sideways action, it always gets my attention. Which way is it going to go through this? The pattern is one of higher lows but lower highs. How many days have you been stuck at this 18-day average? So this is on my radar scope of something that can happen very quickly, up or down. You pay attention to that. Feeder cattle, getting the first inkling of resistance, staying at this 18-day average of closes. The market has had lower highs, lower lows, but divergence. You've got momentum up. The settlement price was over the 18-day average, but the swing line's down. Watching that one. And in the hog market, I totally get that it's stuck at the 18-day average of closes. Think about U.S.-Chinese trade. Maybe the Fed contract wouldn't be the beneficiary of that picking up. It's probably too close to the market right now. But you can look out at the Aprils, go to the August, different months back there, and I'd be looking at those. But I don't know which way that trade deal's going. What I do know is that our Cyber Week sale is coming to an end this weekend. So what I've done is I've offered my charting course as part of any of the research packages that you decide to buy. So if you purchase any of my one-year research packages, which are discounted from my monthly packages, but obviously you're paying a year up front, I will give you the charting course. You can give that to a friend. You can use it yourself. You tell us when you want us to activate it, and that's what we'll do for you. We'll get it all activated, away you go, and you're in the game. It's that simple. You can find out more by going to our website under the word research. It explains all this. If you want to find out about the course, go under our website again under the word education. It explains everything there. you can also click here. It'll take you to the research packages if you're watching me on YouTube. I'm Ira Epstein. You have a great evening, and I will talk to you all tomorrow.